It's my fantastic pleasure to welcome you. And today I'm actually on cable, so it's more loud. You can actually really hear me. Yes, it's great to have so many of you. And after we partied the whole weekend, I hope not all of you have a hangover and will utilize the conference for relaxing, because we really want to do content and we really want to discuss important topics for the alternative investment industry. So why are we here today in this building? This building was built in 1336 actually, and for more than 500 years the guild of the roof, also Zimmerleuten, Zunft of Zimmerleuten, the guild of the roof makers and the wall makers and some other makers have been meeting here for centuries. And now, actually, since 10 years, we are a guild of the capital market makers. What we are doing, we issue financial instruments, right? We issue not only the capital market companies, but we issue the financial instruments. We finance projects, we finance enterprises, we finance entrepreneurs, and we also invest. So we do both. We bring together the capital-seeking corporations and companies and alternative projects with the capital pools of the world. So that's our guild, and I think that requires a lot of skills and a lot of talent, and all this talent is here today in the room. I'm very happy. So, what else? We have more than 200 people on our participation list. It was nice to see that actually we had a larger turnover here in the room. Some people actually decided, no, we will not just join from at home or from the office, we will actually come here. So it's of course much nicer to have all of you here. And really, I invite you, we are a dialogue platform, so I really invite you, please ask questions, make comments, be active, so that we really feel the energy and really, achieve something together today. Just a few words, because the panel is already here and waiting. Remo is looking at me, the first moderator. Just very brief, may I briefly walk you through the program, right? So what we have installed for you today, we will start with the private debt, right? One of the most important and at the moment really very successful asset classes. We have a panel of 4 different providers from Switzerland that offer private debt as an asset class in various forms and variations. So that's gonna, refresh our knowledge and see what we have actually, what pearls we have in Switzerland in this talented industry. Then as a second panel, I'm very proud, after 4 years, actually Joanna and Bern, I met them 4 years ago in Bern when they came with a big delegation. Welcome to Joanna and Bern from Belgium and Luxembourg. They came with a big delegation from the European Investment Fund, one of the most important venture capital institutions in Europe, not only in Europe, but also worldwide. They move hundreds of billions of money into venture capital, which is fantastic, and which shapes our future. So after 4 years, finally, they couldn't resist our invitation, so they come here. I'm very proud to have you, both of you here, and also my long-term friend, Victoria Tigipko, she's already in waiting. I think she's dialing in from New York. She will be joining us on the screen. She's very successful also in venture capital. She is a very important venture capital investor, but she is also a network of iClubs of entrepreneurs worldwide that invest in venture capital and motivate and spirit each other. Then we have the break, and after the break we have 2 more sessions. One is about tokenization. Here we have another pearl. We have the Signum Bank, world's first crypto bank with a lot of highly interesting products and services. And actually, by the way, we have a new board member, Magdalena Boskic. Where are you? Hi, please. She's a new board member of our club. Maybe you want to applaud. So she actually volunteered because we have now the MiCA, the European directive. No, it's not a directive, it's actually a regulation that is directly applicable for all the blockchain issues. So that's a huge new regulation for all of Europe. We are not part of the EU, but nevertheless it's important for us. So she actually volunteered to organize an event on this big topic. And I'm very glad that we have such powerful woman in our board. So that's so much, and she's from Signum, right? So we have now a little bit of Signum in our board. Then, last but not least, Jacob, head of government relations and lobbying in my law firm. He has organized a wonderful panel on innovation, because what's the most important in life, in the universe, and for us always, is growth and innovation. I mean, that's the same, two sides of a coin, growth and innovation. So that's what we want to pursue also with this forum, and that will be our last or our fourth panel before we then actually start with the upper row and continue the party that we just had just a small break now this afternoon from the weekend. So that's so much for the program, and now I would like to introduce Remo. Remo, he has, together with Markus Lienert, Remo Badeter, Markus Lienert, they're also two sides of a coin. They worked a lot in big companies like UBS, like Man Investments, right? You worked in a lot of big institutions, and you also founded your own company, Valvest, and helped to spur growth in Switzerland. And I'm very proud. And please, a big hand to the moderator. He will then introduce his panel. Please give a hand to Remo.
Thank you very much, Alexander, for the nice introduction. I actually would like, in the name of the panelists, Thomas Siegenthaler, Kevin Hinder, Markus Lienert, and Professor Dr. Pascal Böhni, I would like to thank the audience, and I would like to thank Alexander for the invitation that we can run one session about real estate debt here at the Alternative Investment Forum in Zurich. Real estate debt delivers an alternative source of income and powerful diversification benefit in a time when both are hard to find. And this makes real estate debt an interesting investment case. But what really sets real estate debt apart of other fixed income instruments is the collateralization of a real asset, which protects the capital of the investors. Today, we actually have a panel about real estate debt in the second part of this session. And in the first part, Professor Dr. Pascal Böhni will share his thoughts about private debt. Professor Dr. Pascal Böhni is actually professor in finance and private debt at the Tilburg University in Holland, in the Netherlands exactly, and he is actually heading there the Institute for Private Debt. Additionally, he also lectures at the University of Basel in Zurich and at the University in Rotterdam, where he's the academic director of the MBA in Finance and in the Master in Finance. And beside his academic activities, he's also the chairman and the CEO of Remaco Advisory Services in Basel. Remaco Advisory Services is also a partner of Nexia, and they are specialists in advising investors in private debt and other private markets. And we are very glad to have you here. and listen to your analysis and your research about private debt. And with that, I would like to hand over to you, Pascal. Please, the floor is yours.
Thank you. So, everything is said. I think to the protocol, I only want to thank the Lindemann family, so to speak, for their kind invitation and the organizers of today's event. I will speak about private debt in general, and then go to real estate debt on the last couple of charts. And I will use approximately half the time that the Zurich book took to explode yesterday. So my timing should be around 25, 27 minutes, and I hope that I can achieve this target. I will talk about these factors. I thought my speech would be in German, so it's obviously not. So my apologies for those who will have to read that, but I can translate, I assure you, at least the head titles into English. That will work. Okay, introduction, the elevator speech, you can read it on the presentation when you receive it after today's event. Private versus public markets is the battle to watch. This was in the Financial Times from now 2 or 3 years ago, 2019. And it's true, till 2019 we have seen an enormous development in private markets. Not only have the markets grown tremendously, also are they now attacking transactions which have been attacked in the past only by very large investment banking type of firms. So this has really changed the landscape in private markets. These would be the headlines that you would see. You would see big funds raising in the market, like RS Capital raising 11 billion. So it's not 11 million, not 110 million, it's 11 billion. So that's a big number for just one private debt fund in the market to raise capital for their investments. But also, on the contrary to this, we have now a couple of signs in the market. On the left-hand side, you see Moody's, who is claiming that these kind of shadow banking activities need to be supervised more. We need to know better what they're doing, better understand them, give them ratings, of course. Maybe this statement is also a little bit business-driven. We want to rate these private debt funds and their underlying assets so that investors are protected from their activity. And just yesterday, this is the latest article on the market. Is the 12 trillion private market the next shoe to drop? So, in other words, is this something we can forget about in a couple of weeks or months, maybe? I don't think so, to say it early on, but I will give you a couple of reasons and numbers why I believe this is not the case. The first reason is that if you look at traditional markets, and if you compare the private markets in terms of size to these different slices of the cake, on the very right-hand side, you see the private market slice, right? So the total market, approximately 12 trillion US dollars, and you can go and compare that to the total equity markets and the total debt markets in this world. And yes, I agree, 120 divided by 12 is approximately a factor of 10. It's true, but still, private markets are 1/10 of the global equity markets already. Now remember how long these markets have been existing, not so much, not so long. Private equity emerged some, I would say, 20, 25 years ago in volumes. It was there earlier than that, but in volumes, in big volumes, it evolved later. And if you compare those sizes then to the growth, private markets really grow much faster than public markets, be it equity markets, be it bond markets. So private markets have grown at a compound annual growth rate of approximately 12%. This is quite a growth rate in terms of volumes in the markets. And most importantly, and this is what many people forget, if you compare these private markets to the traditional corporate financing sources, you will see that private markets, which is the black bar, roughly 12 trillion, is already larger than the US corporate bond market. And I'm pretty sure, let's say, be fair, 50% of the people in the room didn't know that before. So private markets today are roughly, as large or a little bit larger than the US corporate bond market, which is quite a number. If you look at US leveraged loan markets, what is the volume of US leveraged loans that's there in terms of existing loans? 1.3 trillion. US high yield bonds, 1.7 trillion. So these private markets, if I then talk about private debt funds, 1.3 trillion, about the size of the US leveraged loan market, or just a little bit smaller than the US high yield bond market. So I would say these private markets deserve some attention, surely. And if they continue to grow as they growed in the past, they will become even more important than they are today. Okay. What drives this growth? Okay, well, I'm happy I have the translations in brackets, so I can read my own charts. Okay, we have basically, I say, 5 driving factors why these markets are growing so fast. One is yield-seeking, investors reallocating capital from not so much yielding assets into better yielding asset categories. I will talk about that shortly. Then the bank net interest margin, very important driver. I will give you concrete numbers as to how they drive the private markets. Public market attractivity, we'll talk about that. Performance chasing and the specialness of private markets. Okay, yield-seeking investors. Most of us in the room haven't exceeded the age of, let's say, 70 or 80. So, but if you go back to 1981, some of us might remember that the yield rates or the treasury yields were at the level of between 12 and 16% those days. It's hard to imagine, but it's true. So this is the data from the US Treasury market, and you see the 2-year and the 10-year yields, and you see how they have consistently over decades gone down. So we're now at a much lower level. You see the peak and how they kind of pick up again. But these yields have importantly driven private markets and their growth, right? And you will have the question, well, what does this pick up here do? I will come to this question at the end. If you look at asset return expectations, you can look at the source when we hand out the presentation. This is BlackRock's expectations, and clearly the top end is the private market, or let's say non-liquid asset category, as BlackRock estimates the expected returns. And the BlackRock estimate for private debt and private equity are here. Private equity 10%, private debt 10%. Interesting number, interesting in terms of size. 10% is quite a return, so this would be annual returns. But also, private equity and debt have comparable returns. Also, debt has a much, I would say, more attractive risk profile. And then you go down the scale and you see the 60-40 portfolio with something like 45% annual return, etc., but liquid. And the trade-off is between return and liquidity, and you all know that. Okay, here is the recommended portfolio allocation of a long-term risk investor, being a pension fund. According to BlackRock's, roughly 35% should go into private market assets. So you see a reconfirmation of like, this is not something funny, small, and maybe needs to know. This is an absolute must to know. I would say every asset manager in the world should be knowledgeable about private debt, at least understand what it is, and then talk to experts if they want to allocate capital. Okay, now what is important to know about the drivers other than the yield-seeking investors? I am currently writing a paper on the importance of the bank's net interest margin. The bank's net interest margin in this chart, simply the difference between the 2-year and the 10-year treasuries. You see the gap on the higher level of the chart, and the net margin of this gap here is the gray line, and you see that banks are basically, since the end of 21, making a negative interest if they borrow money short-term and lend it out long-term. At least for a couple of weeks now, you all know what bank lending means. We have all observed Credit Suisse. You all know what liquidity means and bank runs mean. So here is a translation of this a little bit like, okay, banks take money short-term and maybe need to give it back short-term, and they lend it out long-term. So they transform as a bank these delays. And what it does, what these interest rate developments in terms of the yield spread did, is that today banks have net interest margins. That means they don't have a high motivation to lend out capital to corporates. And guess what? This will help private market activities to even grow more in the future. Now, are banks important or not? You don't need to look at the numbers. I know you can't read them in detail, but you will have them in the presentation. But you might listen to what I say. Roughly 70% of all the balance sheet financing of listed companies. So here we're talking about the large companies, not about the small and medium-sized companies. But roughly 70% of all the balance sheet financing comes from banks. So in your head, it would be nice if you connected this chart to this chart. If it's not interesting for banks to lend out money, and if 70% of all the money comes from banks to corporates, this might be a big support for the private market industry in the near future. Here is a chart from McKinsey. I only trust my own statistics, but if it comes to price-to-book ratios, I think we can trust McKinsey. So here you see the different activities of banks. On the left-hand side, traditional banking. So CIB is corporate investment banking, traditional banking, like the mortgage business, the lending business. And you see that the return in terms of attractivity of business segments of banks is much less attractive to bank shareholders if they are in the lending corner, which is traditional banks and CIB, right? As opposed to being specialist banks. So you have specialist banks in financial exchanges, consumer finance, payments, asset management, etc. So also for the shareholders of banks, it doesn't really pay out to be in the lending business. Just to say this, so this is an additional argument why the bank business needs to be observed when we look at private markets on the other side. Okay, here is another chart. How are private equity transactions refinanced, right? The typical private equity transaction in 2010, in 75% of the cases, was refinanced by a bank. So you go to the bank, you say, I want to finance a management buyout or whatever, buy-in, and the bank will say, give me your documents, I will have a look at them, and I will give you the money. So in 75% of the transactions, but also capital weighted, this was money that came from banks. And only in 25% of the cases, this money would come from private markets or private debt funds. Today, in 2020, this picture has also changed, right? So roughly 50% of all the recaps of private equity transactions are financed actually by private market funds, private debt funds, and no longer banks. So this is another argument why it matters. And then we come to the next argument, why should it grow, continue to grow? Well, public market listings get less and less attractive for several reasons. For the cost of transparency in an economic sense, for the out-of-pocket cost of being listed, for being completely transparent in the sense of if you raise money, let's say I want to acquire Professor Hemmig's company. Can I buy your company? Say yes. Yes, thank you.
At the major premium.
At a major premium. I agree to the premium. Let's say we have an agreement on the premium. So we agree, but nobody should know before we close the deal, right? Can I go to the market and talk to the market? No, I can't, because maybe in my due diligence I find some premium relevant argument why I wouldn't buy your company. So I need a private market backup to finance this deal. Even if we get unhappy, I want to be able to, get out of the deal again. And you cannot do that with a public financing, right? You cannot go to the market and say, I need, what does it cost? 2 billion, 4 billion? 5. That's the premium. So already I know it's a 1 billion premium. That's quite high. Okay, so I cannot go to the market and ask for 5 billion and then say, oh, now we canceled the deal, we didn't agree on the deal, etc. Also, debt restructuring. If after 10 years, now I have this bond, then I go back and say, well, he betrayed me. Everything he put in the data room was wrong. Now what do? Restructure my bond, restructure my deal? There is no way to restructure a bond which is placed in the public markets. You can try, but it's quite a hard thing to settle with investors. Okay, so this is the number of public listings. They go down, by the way, in the US and in Europe. The numbers are a bit different. These are the US numbers. And there is a couple of additional arguments why this attractivity goes down. So another argument why discounts. Performance chasing. The crucial thing is whether these funds maintain their high returns, right? So performance chasing is a statistically significant factor that drives growth. If these funds start to deteriorate in returns or performance, the money will no longer flow in the way it flows today to these funds. It's clear today for the more or less riskless liquid markets in dollars, you get something like 5 to 6%. I just said on average, private debt 9%, maybe with these prestigious gentlemen 1 more or so, I don't know, or 2 more. But still, the delta to the non-liquid assets is no longer 7 or 8%, so this has kind of narrowed a little bit, and so performance is relevant, and it has to stay so that private markets can continue to grow. Here is a paper, I just give you the reference. You can read it, it's one of my papers. Here is the return on private debt on the right-hand side. Okay? 9.2%. You see this coincides nicely with the finding of BlackRock. So BlackRock had an estimation model where they theoretically, taking premia on several asset risk factors, how it should yield to investors. I find that past returns have been 9.2%, investment multiple 1.3, but more than that, and this is something I cannot elaborate on that because I don't have the time. I promised half the book time, so I have to stay within my time limits. The public market equivalent is really important to understand. So you compare the return, you discount all the cash flows, distributions and contributions to a fund with a discount rate that is basically the discount rate of the cash flows you would have earned with your public market benchmark. And if you do that, then the question is, do these funds outperform or not outperform the market benchmark, right? So you see those outperformance numbers, 8, 4, and 6% against the investment grade, high yield bond market, and even against the stock market. So the good news is these funds outperform all three markets, investment grade, equity markets, and high yield markets, but the dispersion of these returns is quite large. So, and now it starts to get interesting, I think, for you, and many of you, I guess, are investors. The question is, how do you get the good ones and not the bad ones? It's like with any other asset class, right? So there's nothing in this asset class. There is a couple of things that are very special, like volatilities and returns, but you also have to make a choice. So the worst funds are also, I wouldn't say blessed, but they show negative returns. So you have to be selecting actively, or at least have an advisor who knows how to pick the good ones versus the bad ones. And then some of you will think, yeah, IRR is a bad measure of return. I completely agree. IRR is a terrible measure of return, but everybody looks at IRR. We can talk at the opera why IRR is bad. So, okay, here is a traditional standard alpha sort of exercise. For those of you familiar with the Pharma-French style of regression analysis, these are not the Pharma-French factors. We again took the market factors, investment grade bonds, high yield bonds, and stocks. This is a quarterly alpha, 1.6 multiplied by 4 gives more or less, in a simple way, the annualized alpha. So these funds generate alpha. Now, depending on your investment strategy, whether you're an active bond investor, for example, in terms of debt, or passive, just replicate the index, you will either, as an active investor, look at alpha, or you will look at the betas. Huh? And what you can see is there is beta, right? There is not only alpha, there is also beta. So it is not true that these markets are completely uncorrelated to public markets. How can I say that? Well, first, I know. But second, you can calculate that. You can do that on your own. The thing is, it takes a little bit of time. You have to unsmooth returns. So you have to break up the staleness of returns. You have to account for dims and betas, which is, again, another exercise, which is special to private markets. But you can do it. And the numbers will tell you, I am correlated with markets, but I have alpha. So the bad news is it's not completely market neutral, as many product providers will tell you. It's not market neutral, unless they give you the time series of returns that you can then unsmooth and use the dims and betas. I will gladly do that for a fee. But it creates alpha, right? It creates alpha. And the alpha thing is a good thing. Okay. So then, the specialness of private market participants. Are they special or not? Well, here are the three arguments that you hear when you talk about banking. What makes banks special? Why do we bail out banks, etc.? What makes them good? What makes them special? Basically, three abilities: the ability to screen borrowers and structure transactions around private information. So bankers, it has become famous under the expression relationship banking. Bankers know their clients, that's at least what they claim, and they know it, they extract rents, they give you money, they monitor you closely, if you recognize it or not. These lunches also have to do with monitoring sometimes. And then they extract private information, and so they have you. There is this typical, you know it from Rajan paper, 92, I think, this bank hold-up problem. So once you want to get rid of a bank and they know everything about you, so you keep there, you know, you have this relationship developed and you're a very loyal bank client. I say debt funds can do all of that. I would say there is nothing that debt funds in general cannot do. Can do. Whether they do it is another question. That's an exercise for the due diligence. They can do, but do they do it? Private market, I would then say, adds a couple of additional features which you don't see in the banking markets, or not as prominently see. Private markets are largely unregulated, which means they get a lot of flexibility. So let's give them the benefits of the doubt. Let's not say they're bad guys because they're not regulated. I would also say regulation is something maybe to discuss later. Why should you regulate somebody who has zero leverage and only institutional investors? To be discussed, I don't know. There might be good arguments for, but also good arguments against regulation, right? New capital solutions. There is a whole paper on what do these debt funds provide to the receivers of capital, to the borrowers, right? And they receive a whole, larger, more flexible, I would say, bundle of capital solutions that are not typically seen in the banking or in the public bond market sectors. Okay. Very good know-how and speed. Most of these generally well-trained investment bankers that you now see in the private markets have been working at a managing director or equivalent level. So this will change over the next 20 years, I guess, but this decision-making private debt fund managers are well-trained, know what they do, have been in investment banking typically, or commercial lending, or syndicated lending, etc. And in that sense, they have know-how and speed. No disclosure regulation, right? So if for our acquisition, I call the debt fund, so of course they will sign a non-disclosure agreement. If we don't agree on the price, nobody will learn. If they agree, we can have a glass of wine and be happy. Absorption capacity of risk-shifting positions. And this would be a good question. Do I have time for one question? How much of the debt capital that the bank issues to the market is after the issuance of that debt capital kept on the balance sheet of the bank? Who believes it's more than 80%? More than 80. Who believes it's more than 60%? More than 50? More than 40? More than 20? You see I'm going down. It's approximately 15%. So most of us don't know that. So the banks are in syndicated lending. The lead bank, they take the lead, they distribute whatever they have, and mostly it goes to either financial products, CDOs, etc., to partner banks, to institutional investors, very important investors in these syndicated loan markets, and they keep whatever, 10 to 20%. This was different 30 years ago. 30 years ago, they kept something like 60 or 70%. So banks today are different from banks a couple of years ago. Okay, I have to check my watch. Is this the turning point? Are we at the turning point? Is it that private debt is going to disappear or banks are going to disappear? This is the forecast of PitchBook. And I think just look at the picture. The picture is these private markets have been growing, but now they have a drop. And I think this is the right picture. And they're going to continue to grow, I believe, as PitchBook believes, right? For the reasons that I just mentioned. But it might be that I have a 1, 2, or even 3-year intermediate drop, so 22, 23. I think also private markets will see a drop. Why? There is a lot of capital in the markets. We have a macroeconomic kind of slowdown that we can all observe. So if there is a macroeconomic slowdown, there is a lower demand for credit. If there is a lower demand for credit, well, these debt funds have been, they have received a lot of capital in the last few years, let's say. So they're sitting on tons of capital. And I don't think that capital raising will be that active in the next 1 or 2 years. Doesn't matter. Imagine the banks existing for hundreds of years. They have been growing consistently over time, and that's fine. And the private markets, I believe, will do the same. Here is real data that I looked at. So how have these capital raising activities looked like? You see somehow, you know, it's not really a peak, but it changes the speed of how much capital is raised in the private markets. The top number, or the top line, is private equity. The bottom line is private debt. The yellow and the gray is the trend line. And what you see is, if you take first differences, so this is the difference quarter-over-quarter fundraising, you see that the movements become larger. So some very good quarters, some very bad quarters. So the trend that these funds follow is no longer narrow, as it is the case after the financial crisis and the European debt crisis in 2013 and the ongoing years. Okay, what does the bank lending do? Just remember the two numbers at the top. The quarterly fundraising in syndicated loans, or the syndicated loan issuance, is approximately 75 billion on the world in the advanced economies, which is the left-hand graph. And this compares to 250 billion US dollar in private markets. So today's capital flows are clearly pro-private markets. And even if these private markets now suffer some decline for 1 or 2 years, it's still a sizable number. I'm not saying it's, you know, I just want to say this is quite a sizable number, and we should keep our eyes open for private markets. How long does it take to raise funds? Interesting. It took less and less time to raise funds. So from the moment the manager goes to the market and says, here is my new fund, can you please give me a capital commitment for a fund? This time is now roughly, the yellow line, a month to close for private debt, roughly 18, 19 months. That's quite a long time to raise capital, right? It was at something like 15 months. Private equity below that, 12 months, 13 months in 2016 and 17. And how much do they achieve in terms of target fund size? So they say, I want this fund size. Do they get 100% or less than that? I'm still in time. I see they're getting nervous, but I'm still in time. So bear with me. Okay. What are the impact factors, so to speak, or standard factors in the regression analysis? I just give you the big picture again. I think, believe, and also can evidence with some empirical work that yield-seeking, bank margin, performance chasing, standards tightening of banks, which are regulated, and risk compensation drives these markets. And I can say, I mean, for those of you statistically interested, we can talk about these significance numbers and the signs, but the major message is that a 1% increase of the bank net interest margin increases or decreases private market fundraising by some 57 billion in private equity and 27 billion in private debt. So this is also quite a large number. So a 1% increase reduces private market capital flows, and of course a 1% decrease also increases private market capital flows. And what have I shown you before? I have shown you that this bank margin has decreased, so it should support the capital flow to private markets. Performance chasing, also significant, but less of an economical importance, right? Performance chasing, a 1% increase, increases the capital flow by 3.6 billion only. So you can see that the bank channel is really, really important. Yield seeking, an increase of the treasury yield reduces private debt fundraising by 14 billion. So you can gauge these three effects: yield seeking, bank margin, performance chasing, the most important, bank margin, right? So if you're sitting on a board, you want to talk about this, take this, I can send you the paper, it's going to be published in, don't know, until published in a journal can take years, but at least on the Social Science Research Network, maybe in 3-4 weeks or so. Okay, now let's come to real estate debt, and I'm only spending like 5 minutes because we have prestigious experts in the field, and I see I can keep up to my half the work time promise, so I will. What creates commercial real estate value? Commercial real estate value in the sense of how is the asset valued in the market, right? And this has been looked at by a couple of scientists. It's the investor required return, so how much does an investor ask in terms of return from asset managers? What's the cap rate, so how are these assets valued in the market? And the cap rate includes the risk-free rate, the premium, and the rental growth. So what's the rental projection for the future? Capital availability, how much money is there? And some market frictions. And so these are the last 4 charts before my colleagues can intervene and say everything you said is wrong. But I think some facts are true. So what you see is, why did I show you this chart? This is the global financial crisis in 2007, 2008. You can see that apartment buildings, office buildings, black line, warehouse buildings and retail buildings, have lost value, that is clear. But these values, they co-move, right? They co-move with economic cycles. That's not a surprise, right? And if you look at the next chart, this one, they lost value at the worst point in time of approximately 40%. So if you ask the colleagues afterwards, do you think LTV, loan to value, is important? I think here is the answer. Commercial offices lost most of the value, 39% in the crisis, 32% housing prices, 35%. But they also, regained those losses after that. And then the other chart are just, the covariance of capital availability and asset prices. So this has connections in the market, and you should look at that. If you're interested in these results, here is the reference on top of the graph. You can just go on Google Scholar and look it up, and you will have also all my contributions and sources will be in the appendix. So I want to thank you. I'm exactly in time. And I will then join the panel. I think that's the plan, right? Thank you. Yes.
Pascal, thank you very much. It was very interesting, and there is lots of work involved, and we appreciate it that you share all this very interesting information with us. I mean, I was impressed about the huge number about private debt anyway, but real estate debt is a massive universe, and it offers lots of attractive investment opportunities over the wide range of the risk-return spectrum. And therefore, I'm really happy to have here specialist experts who can talk about investment opportunities in real estate debt in Switzerland with Thomas Siegenthaler and Kevin Hinder, but also some experts in commercial real estate debt who can talk about the market in the US. And with that, I actually would like to introduce the panelists quickly. On my right-hand side, there is Thomas Siegenthaler. Thomas Siegenthaler has 30 years experience in international banking. Thereof, he worked 25 years at UBS, where he was actually the chief credit officer of the whole wealth management European unit. And he also was the chief operating officer of UBS Monaco at that time. And during his time at UBS, he managed lots of lending portfolios. He made lots of credit decisions. He was involved in asset-backed security transactions, but he was also involved in the sale of distressed portfolios. And in 2021, he co-founded Cresolution, and Cresolution is an independent lending advisory firm here in Zurich, where he arranges non-standard loan structure for ultra-high net worth individuals and also for real estate investors. Thank you very much and welcome here at the Alternative Investment Forum, Thomas. Then Kevin Hinder, he's the CEO and co-founder of Property One. Yes, over 15 years experience in real estate as well. and he actually developed the company, Property One, over the last couple of years into a large boutique asset manager with focus on real estate debt in Switzerland. Today, Property One has 50 employees in 4 regions, and they also launched in 2021 the first real estate debt fund with focus on Switzerland real estate debt here in Switzerland. Therefore, appreciate to have you here as well, Kevin, and we are very excited about your information afterwards. And then, third, Markus Lienert. He is the CEO and co-founder of Valvest. Valvest is specialized on US commercial real estate debt, and Markus actually started his career more than 20 years ago approximately at the pioneer in fund of hedge funds at RMF, where they were specialized in the fund of hedge fund solutions for institutional investors. And over the last couple of years, Markus actually developed into an alternative investment expert, and he has great knowledge in managing commercial real estate debt portfolios. Okay, we have 3 experts here in the field of real estate debt, and I would actually appreciate if you could quickly give a bit background about your company. Track record, knowledge in CRE debt, also where you put you on the capital structure, just in short, please. And with that, I actually would like if you could get in 1 or 2 pages further.
Use the time to add some more information to the introduction. Thank you for having me here. So Property One is, as you said, an asset manager for real estate with a clear DNA in real estate and real estate financing. So this is probably the connection between these 2 industries makes us a little bit more special than maybe just other debt providers. And we are clearly focusing on the second rank of a loan, so up to 80 loan to value, and I'm happy to answer questions about loan to values later, but we are really only focusing on the Swiss market. So this as an add-on information for the beginning. Thank you.
Thank you very much. Kevin, please. I actually would like if Thomas could start.
Yeah, sure.
Your company background, a bit track record.
So as you said, thanks for the introduction and thanks for having me. Cresolution is an independent lending advisor, and we also manage our own private debt instrument that invests in 2 loan types. One is, and we don't speak about this afternoon, is in asset-rich, liquidity poor, ultra-high net worth profile, so people that are rich on paper but need liquidity, it's bridge loans. The second one, which is the topic, we invest in residential real estate development financing, where the normal structure in Switzerland is the bank provides 60 to 70% of the investment cost. We then provide the next 15 to 20. We always require 15% of equity. I know it's not covering all the market volatility, but I will explain later how we manage this. Typical pricing is the Saron, which is the new Swiss version of the LIBOR, plus 600 to 800, plus we get a structuring fee, which is approx 1.5%. The maturity is between 12 and 36 months of those loan types.
Perfect. Thank you very much. Markus, please elaborate about Valvest.
Valvest is specialized in the US bridge loan market. We are actually the first and only regulated provider here in Europe that allows European investors to access this huge market through regulated vehicles. Remo mentioned it, we talk about the big market, commercial real estate, that in the US is a 5 trillion market. This is 3 times bigger than the US high yield market, so 3 times bigger than all the high yield bonds you hold in the portfolios of your clients. We at Valvest, we focus on bridge loans, always in a senior position, so we have the most senior position in any real estate transaction. We have the first mortgage, we have direct access to the collateral, and are able to generate returns in the high single-digit range. 8 to 9% is possible.
Thank you very much for this background information to all of you. I mean, I would like to ask a question about how you structure the loans, about the security of your loans, and as Pascal Berny showed in his presentation on the last slides, I mean, there are price decreases, and therefore, please, Markus, if you could start to tell us how you structure the loans in the US that you can avoid these losses.
Yeah, I mentioned we are a European regulated entity here. We have a team on the ground in the US who is actually responsible for sourcing deals, being close to the market. In our DNA, the first thing is capital preservation. We evolved out of a family office, so we would like to preserve capital at any time. And what we do is always a first mortgage, always a top asset, might it be next to Bloomingdale's in Manhattan or any other metropolitan area. Very strong borrowers, and at the moment at least 50% equity from them.
Thank you very much. How do you do that in Switzerland, Kevin? How can you avoid losses for investors?
I think, I mean, top priority for us is definitely capital protection. So when I look back at 2022, we had requests for loans over 1 billion in Swiss francs, and we did really cherry picking, so our closing rate is approximately sure below 10%. So we do cherry picking. So we source the deal that we are really feel secure. So that combined with the deep due diligence in the real estate asset with our specialists out of all the different segments that we have in-house, I think we can make up our mind quite well. And next thing also is we don't want to find it, but we look at the possibility of a worst case scenario. So we want to have the solution by the time we pay out the loan for the worst case scenario, excuse me. So with all that combined together and with the traction over last 8 years, with over 750 million of paid out loans, no losses in that time, I think we have quite an experience, what makes us even more cherry picking for the future.
Thank you very much, Kevin, for that. I mean, it looks like that you have all a very prudent approach. Thomas, could you please add something to that?
So it's very similar to Kevin, right? We assess the project. The track record of the developer is very important. We never finance the first project, so cherry picking, as Kevin said. The second one is the clear exit, right? The exit can be the sale of the project, either as whole or apartments. The second one is actually refinancing. So in Switzerland, often the bank looks at the cost of the investments, but at some point, takes the market value with the future, like prices of the real estate project. In the past, it was always higher than obviously the real estate investment cost, so we then arranged the refinancing. The third one is that the borrower has probably another asset that is in the process of sale, and we bridge the situation. And what is very important is actually that on the financial strengths, right, as we said, you need 30% for real estate financing in equity. We ask for 15%, so how we do that? So our borrower has always other assets, In most cases, we even have personal recourse. So those borrowers are family-owned real estate developer who then really, besides the 15% in real equity, they would be liable with their entire private wealth. And obviously this increases the motivation to pay us back, which is a very interesting or very important pillar. And the fourth one is monitoring, right? So we speak every quarter, once a time. What is the development? How is the sales process? Is our exit still in go? Do we have any cost exceeds and things like that? So I think with that, we have quite a sound package to mitigate the risk, right? We also have no loss, but our product is 9 months in the market, so it's not something, I can shine as Kevin can.
Hopefully continues like that, and as well, a very prudent approach, I think, which is one of the most important things we also heard at your presentation. of these private debt managers. I mean, there is also market risk, and I would like to ask you about the impact of market changes on your strategy, but also on your borrowers. And I mean, what we saw over the last couple of months with rising interest rates, this environment has changed dramatically, and interest rates are one of the most important measure in real estate debt. And what does these higher interest rates have kind of an impact on the strategy on one hand, but also on your borrower on the other side? Thomas, please, if you could.
Yes, that's a very important point, right? But we start really with the big picture. And the big picture in Switzerland is we have since a couple of years net migration. So more people coming into Switzerland and leaving Switzerland. This is translated, we are currently short 25,000 apartments. I just read a report that in 3 years we're going to be short 40,000 apartments, right? So this gives me quite an important security on those asset prices. So I don't expect asset prices to go down by 30%. Secondly, yes, obviously the increased cost interest rate cost affect the financing cost and maybe affect then the sales price for my borrower. How we manage that, what we have done in the last six months is actually we are focused on projects where we have visibility, and visibility means that have a maturity of 12 to 18 months, right? So currently we don't finance projects where the loan is 36 months. We are focused on very short loans, and that's how we manage those kind of interest rates. By the way, I personally think those interest rate increases were very predictable so far, right? So it was announced and it actually happened. So I think the bad surprises or the speed would actually hamper our asset class, yeah.
Thank you. Thomas, Kevin, would you like to add something? How you do it in Switzerland with rising interest rates?
Yeah, the rising interest rates on the existing portfolio actually pushes the performance because all our agreements with the borrowers are on SARON floating plus the customer margin. So we have a better performance, or at least we go with the direction. Second is, and I can repeat a little bit, we do really prioritize the deals that we want to invest in. And there we need all the know-how from our real estate experts to double check once more or even deeper in the due diligence process to find the right deals. So we are a little bit more cautious, and probably cherry picking rate gets higher.
Thank you. And Markus, how do you do it in the US with this higher interest environment?
I can't add much more. First is, what is the value lended against? That's a simple LTV question. We are fine, we have low LTVs. Second is, all our loans are floaters in the market. If you have floating SOFR plus 5.5 spread, you end up now at 10%, which is nice for investors. What we changed over the last 18 months, and Thomas said it, interest rates moved up. Everybody knew it's going to move. Everybody knew what's going to happen. So what we did is we went even more defensive, more multifamily, even lower LTVs, and we even asked for an interest reserve on day one. So we only finance people that bring 50 equity and 18 months interest reserve in my hands. Everything else is a bit dangerous.
What about the opportunity set? I mean, has this changed as well in the meantime, from low interest rates to high interest rates?
I know Alexander would like to finish over there, but to add up on Professor Bernie,
I would suggest that we maybe have a final round of questions, and you already prepare your questions, because we are a dialogue platform.
I only have one,
so
one more question,
prepare
and then I would
question in the room also, please.
Would use the questions as well, yeah.
To add up from Pascal Bernie, I mean, banks move out of the business, of the lending business. This creates an opportunity set which is huge. In the US, we talk about 500 trillion that need to be refinanced every year over the next 3 years. And we believe this is going to be a great opportunity to generate high single digit with very low valuations and risks.
Where are the opportunities in Switzerland? Kevin, please.
Opportunities, I think if it comes about timing, and also I guess that the banks will reduce their leverage as well. So we just step into that open space, And I think the playground gets bigger and bigger for all of us. And I'm happy to welcome all our competitors to join that asset class. Yeah.
Thank you. Would you like to add something, Thomas?
Just, it's very interesting that a bank gives you or provides you financing up to 70% loan to value, and you have like a return of 1.2%, right? And we finance 71, maybe to 80, 85 with this additional package, as Kevin and I said, and your return is actually 5 to 6 times that of a bank, which I think is for investors should be a very attractive asset class. Right?
Of course, and lots of opportunities available. And as we saw in your presentation as well, this market is really attractive for private debt investors, even though lots of investors, particularly in Switzerland or in Europe, are underinvested in real estate debt. And if they now move into real estate debt as investors, I mean, what can they expect from these funds, from your products? If, Kevin, you would like to start.
Yeah, from our product, I think our portfolio, the fund is now 180 million, but we're chasing a growth, and I think we will have a bigger portfolio, and through that we will have a better, let's say, a better diversification, and probably we will just provide the same performance as we did last year, so you can expect higher than 5.5 after costs. Yeah.
Okay, thank you very much, Kevin.
One or two questions from the audience would be nice. What are you thinking?
Are there questions? Please.
That's
Interested to know what the typical ticket sizes are. Well, the typical ticket sizes are
That's
that you
a
do
nice
within
question.
the funds, and sort of balancing out the advantage of diversity through more investments versus the amount of time and effort it takes to put into a deal and due diligence.
So in our case, we are focused on projects with total investment costs between 10 and 30 million. This means the ticket size is 1.5 to 3 million. And currently we manage 10 to 15 loans. Once we are a full size, fully invested, it's going to be something like 30, right? So compare that, the bank has to manage thousands of loans. We are focused on 30. We cannot because our risk premium is higher than the one of the bank, as I just explained.
We focus on size between 15 and 35 million. So we actually look for a top-class asset in one of the main cities in the US, which means, on the other hand, that every real estate investor that is in the deal with us has to bring 15 to 30 million equity on the other side. So it's less about diversifying the portfolio, but get as much skin in the game as possible to have him on the hook.
Our ticket size is about, so we have over 45 credits outstanding, so it's about 3.5 to 4 million average ticket size.
You're from the family office in the UK, right? We have a question. Maybe you can stand up and introduce yourself.
Hi, Antonio Curia, my name. So, considering a little bit the slowdown in the market that is happening, no? Recession looms, Europe, US, how you guys manage the risk of defaults? How you guys do the investment process to avoid, actually?
So shorter duration of the loan, better visibility, as I said, right? I still believe in the asset prices here in Switzerland because, as I said, net migration, so we get all the people from Britain now coming to Switzerland. Just joking. But yes, Switzerland actually has more people, so more demand for apartments, which I personally think that the asset prices will be kept. And then if one project really fails, as I said, we have access to the other assets of the real estate company, or even worse, of the person behind.
I think risk management already starts at the time of origination. So once you have the loans, your decisions are made. So actually now, or the last 18 months, you focus on very low LTVs, which this is the buffer you actually have to protect yourself. Now, we talk about commercial real estate, we talk about US, we read a lot. All loans are performing and are paying, but the opportunities actually just arise. If you finance something after a 50% discount and you finance 50% of it, I'm in with 25% valuation. I'm happy with that.
So, okay, because the time is advanced already, I mean, we would like to stop here. Thank you very much for your patience, and all experts, they are still here in the breakout sessions, and therefore we can discuss every question afterwards as well. Thank the panelists, thank you, Pascal, for the presentation. And
thank you very much for Remo. Thank you very much.